I think that there's a few ways to read it. So, I mean, first of all, I don't think anyone expected that those tariffs were going to be rolled back at all. So what is the point of making the point that they're not? So it's just kind of to poke China a little bit. We had the positive news, again, not unexpected, that they've been removed from the currency manipulator list, which was also pretty well expected. So these things are, kind of unnecessary, but also obvious. I think if the point of the Trump administration is to kickstart phase 2 negotiations, which I also don't think anyone really expected would be done in earnest until after the election, if that is the point, then maybe that's the way to go. And as has been indicated earlier, I mean, President Trump is pretty good at brinksmanship and these sorts of I wouldn't describe them as games, but they're a little bit like games. So I think there's a few ways to read it. Now, obviously, the worst case scenario would be if the Chinese take this the wrong way and decide not to sign this evening. Obviously, given the very strong start we've had to market so far this year, it's well reflected in the indices, et cetera, that this is going to happen. So if it doesn't, it's a bit of downside.
Essentially. Dan, come in here.
Hey there, Kieran. How do you think asset markets are going to react to the signing of this phase 1 deal? Do you expect that most of this is already priced in at this point?
Yeah, I mean, as we just sort of discussed, I think it is pretty well priced in. So the surprise would be a potential negative surprise if we do not get the signing later today. So that's what we think. I mean, if you look at how markets have performed in let's say the fourth quarter of last year and first month so far of January, markets are up extremely strongly against an earnings backdrop which hasn't really changed. And what we mean by that is that earnings in the U.S. have been flat over the course of last year, and earnings in Asia and also Japan are still declining and have not yet bottomed after peaking a year and a half ago. So, the fundamental picture has not changed. This means that all the performance we've got over the last 18 months is really driven by valuation re-rating, which needs to be ultimately supported by earnings. Or otherwise, it's a big risk out there.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.